Okay, good morning, everyone, and welcome to MACROACE with your host, Tony. Also, doing this for Financial Juice Elite, if you saw that post on the feed. But Nonfarm Payrolls, we've got quite a bit of prep to go through, so let's get right into it. So, Nonfarm Payrolls, first of all, what is it? It represents the net amount of jobs created in the prior month, and you have two surveys. One, which is a household survey, which is where the unemployment rate is derived from, and the establishment survey, which is where the head figure or the headline figure for non-farm payrolls is derived from. And you have 629,000 corporate and government work sites where the government then collects data on the number of employed people and the amount of jobs that are open within those businesses. So with the market effect, then how does it affect the market? Usually with the currency, if data is stronger than expected, then you usually see the currency going towards the upside. Stocks usually take a hit with stock indexes, of course, and the bond market, bond yields see a rise. And the reason why that would happen is there is the expectation then that the central bank is probably going to be more hawkish or look to keep rates where they are on hold if they're pretty high at the moment. Then maybe later on when data starts to become a bit more accommodative to what the central bank is looking for weaker employment figures, then they'll look to start to cut interest rates. But at the moment, central bank is not looking to cut interest rates until the September meetings, what the expectation is for when the first rate cut is expected from the Fed. But the opposite side then, if data is weaker than expected, as said earlier on, if data is weaker than expected, the currency will then see depreciation, stock indexes will see an appreciation, and bond yields will see a depreciation, in the anticipation that the central bank will then be more inclined to cut interest rates. The likelihood of cuts increasing this year depends on how strong or weak. It depends on how weak the data is from non-farm, but also the other bits of data too in regards to inflationary bits of data, CPI, PCE, and any other points of data as well. But generally, stronger than expected. Data is good, is bullish for the currency. It's bearish for stock indexes and bullish for bond yields, and then vice versa. So let's take a look then at what we see within the indicators then weighing in on sentiment at the moment. So inflation at 3.3% compared to 3.4%. PC price index at 2.6 compared to 2.7%. GDP Q1 at 1.4% compared to 3.4%. ISM manufacturing employment at 49.3 compared to 51.1. Remember, a figure below 50 shows that that part of the economy is in a contractionary area. But anything above that shows the economy, that part of the economy is in with the expansionary area. Also, I hope you guys enjoyed Independence Day yesterday. And we also had the election at the same time in the UK. But yeah, good morning to you too, Billy Goat. Good morning from California. Good morning to you too. But anyway, as I was saying, let's carry on then. Manufacturing PMI was at 48.5 compared to 48.7. Non-farm payrolls last time around was at 272k compared to 165. Then the ISM data. Now this is quite important, not just for the services side of the economy, but also how it affected the dollar yen, or had an overall effect on the dollar and where the yen is at the moment. So ISM services employment is at 46.1 compared to 47.1. Services went into contraction for the PMI to 48.8 compared to 53.8. Now, the yen was around 161 on the dollar yen. And then after that data had come out from the ISM services PMI, then we went to about 160, kind of hovering around 160 at the moment for the yen. But that weaker bit of data then helped provide some, then gave a bit of impetus then, or less of an impetus, let's say, for the government to then look to intervene within the FX market. Now that wasn't really a big old move. overall for if we're looking at it in the broader term, in the broader picture. But it was still quite important that it gave the yen then a bit of breathing room to kind of go, okay, we're not going any higher, so there's less of a risk then of the government having to do anything to intervene within the market. Also, with the JOLTS data that we had this week, came in at 8.14 million compared to 7.91 million. Employment costs is at 1.2% compared to 0.9. The ADP employment change, what we had this week at 150k compared to 157, which was weaker than what the forecast was at 160k. Average earnings year on year ticked up to 4.1% compared to 4%. Okay, we're getting a lot more good mornings. Good morning, Umar. Good morning from Lagos. Andil, good morning. Good afternoon from South Africa. Good afternoon. Why did I say good morning? Just everyone else said good morning, so I got stuck in that pattern. Not a good sign, is it? Anyway, my excuse is I stayed up late for the UK general elections to see the numbers coming in. Okay, let's carry on then. So if we look at then the triggers then for today's economic release, and then also for the Canadian employment change data too. We'll go through sentiment and some past stuff for that too. But non-farm with a high estimate of 237k and a low estimate of 140k, of course with a forecast of 190k. So you're looking at about a 50k deviation on either end, and that's what economists are looking at for the high and lows. For the headline figure non-farm, the unemployment rate about 0.1% deviation on either end, forecast being 4%. The Canadian employment change, there's a bit more mixed. So economists are looking at a high-end deviation, a total deviation about 48k on the high side. So with 73k as what the actual figure could come out as on the high side, and 20k on the low end. So 48k deviation on the high end and about a 5k deviation on the low end. Unemployment rate, looking at a 0.1% deviation on either side with a forecast of 6.3. Average hourly earnings year-on-year data is also going to be quite important for the overall picture then what we get from non-farm payrolls. For high estimate of 4.2% and a low of 3.8. So looking at a 0.3% deviation on the high end and 0.1% deviation on the low end. Private payrolls with a high estimate of 201k and a low estimate of 115k. So looking at about a 45k deviation on either the high and low. Now bearing in mind, if you're seeing this image, this is also available to anyone who's subscribed to the MACROACE main list in the ranges and deviation sheet, which is updated every day with the forecasts for the economic releases, high and lows. But you also get to see other economic releases too, and see how the markets have reacted to those from the data. We'll have a look at it a bit later, but let's get through this first. We got quite a bit. So the previous report then for May on June 7th, we'd seen that government had seen about 43k rise, healthcare at about 60k jobs, social assistance about 15k, leisure and hospitality about 42k, and retail trade about 13k. Then if we're looking at the Fed and government views, Powell on July 2nd stated that there has been a substantial shift towards a more balanced labour market between supply and demand for workers. He continued to describe the job market as strong, but noted that it is cooling off appropriately. If the labour market unexpectedly weakens, that would also cause the Fed to react. So that would be if inflation is a little bit sticky, but the employment data is weaker than expected for consistently over a period of time, at least 3 months, is what economists look for to get like a good like an idea of a range rather than focusing on one bit of data. Then that could push the Federal Reserve to then provide maybe more rate cuts than what they're expected to do. So that's something just to bear in mind with comments that come out from Fed members when they talk about the jobs market, and then when you look at the data and how sensitive the market is to the non-farm payrolls data. I mean, it always has, besides the COVID period and any other black swan events that we've had. Fed's Powell on June 12th said that unexpected weakness in the labor market could also call for a response. So just a reiteration of what he said earlier, he reiterated that, saying the same thing on July 2nd. June 28th, Fed's Daily said if inflation comes down or the labor market falters, that we can adjust policy. She also said on June 24th that if inflation falls rapidly or the labor market softens more than expected, lowering the policy rate would be necessary. June 18th, Fed's Musalem said that the labor market no longer seems to be overheated but remains tight, and I expect some further cooling in the labor market in the coming months. Fed's Kugler said that most indicators point to a slow and steady easing in the labor market. Barkin said that the labor market numbers are very strong, but inflation is still not at target. Williams says that we will have a strong labor market with some hiring slowing. And then from the government side, Treasury Secretary Yellen on June 13th, she said that the labor market remains strong and that the US labor market pressures have eased and wages are rising more slowly. So overall, the picture is jobs data is relatively still strong, and the labor market, there's still a little bit of tightness there's left there, but it is improving. If it were to falter or weaken for a period of time, then that would push the Fed in the direction of, right, okay, can't let the jobs market falter, because then that will lead to a depreciation in productivity and consumer spending, and then or potentially lead to a drop off in GDP, and then a potential recession that could occur, whether it be huge or small one. The likelihood, hopefully it isn't. Hopefully there isn't. So far they've done quite well, the Federal Reserve, with their monetary policy. So, but of course, besides getting inflation to 2%, still 1.3% higher. But anyways, they've done quite well so far, so you kind of got to give them credit for that, whether you like them or you don't. So investment bank views and market views too. So Morgan Stanley on June 30th, they said that June payrolls slowed to 210k because of softening demand for and supply of labor. They forecast no change in the unemployment rate of 4% and an average hourly earnings rise of 0.3% for the month-on-month, and slowing to 3.9% for the year-on-year. JP Morgan, they said that they're looking at non-farm payrolls gain of about 200k in the June employment report, and for the unemployment rate to remain unchanged. They said that payrolls have risen by an average of 249k a month over the last 3 months, and by 230k a month over the last year. So that's showing that the jobs market is still strong, but it's slightly stronger than what it was last year. So that's something to bear in mind too, with what when the Federal Reserve then decides to start cutting interest rates, and if it is actually going to be September, or if it gets pushed back further. If data is not only stronger than the forecast figures, but also compared to the prior figures too. That's something that, okay, as day traders, we're looking at what the actual figure is compared to the forecast, and we make our mind up as to how to trade it, and then the markets go yay or nay. But then from the economic point of view, what the Federal Reserve is also looking at is the prior figure too, to see, has there actually been, was there an increase or decrease in the number of payrolls this month or over a period of 3 months, and then they can make their own judgment on that. So that's also something to bear in mind, is the prior figure. We can't push that out of the back of our mind entirely. They also said that for some time we have expected a gradual slowing in payrolls, given A, job growth averaged under 200k a month for every year between 2016 and 19. B, the unemployment rate has been slowly increasing. And C, the participation, excluding the oldest workers, is already likely or at near a cycle high. Now, with the business cycle, that's important. If the economy is churning out a lot of jobs and there's a lot of productivity, a lot of consumer spending, then at some point that starts to decelerate. And when that starts to decelerate, that's what JP Morgan is talking about, and then there would be an expected slowing of the labor market as businesses start to produce less jobs, and there isn't that much of a need for any more workers. Then that occurs. Goldman Sachs said that the payrolls report will be an important policymaker, especially as our economists have cautioned that the labor market is approaching an inflection point, where further weakness would be a cause for concern, but this is a narrow path for substantial and sustainable dollar weakness, especially in the current environment. And then ING on July 1st, that they said that the DXY, or the dollar index, may break below 105 on softening US jobs figure, and a dovish Powell, which is the comment that he made, the comments that he made earlier in the week, which were seen as slightly dovish. They also said that, but may then encounter increasing support below that level. So we could see a break below that one of ING said that you could see a break below 105 on the DXY, and then it could then see another level of support that is then created, or a bit of a range that is then created, a new range for the dollar index. And then we could be heading into some continued weakening for the dollar. So you had Powell, they mentioned that. So we also, if we're looking at market views, then expectations, Powell sounded rather upbeat then on disinflation. That this is what ING were referring to in their expectation for what Powell could be like in his speech this week. So they said he sounded rather upbeat on disinflation, even though he continued to warrant caution on the next policy moves. Markets are now pricing in 18 basis points worth of easing by the Fed, and 45 basis points in total by year end. Hopefully the stream didn't cut out for you guys. Okay, I think we're all good. All right, so if we're looking then at the expectation of what the Federal Reserve is expected to do. So 91.5 probability of no change for the Federal Reserve at the July meeting. That's pretty much baked in, and that's not something that's is going to occur. But the chance then of a cut is at about 8.5%. Small, but kind of likely that would be, you'd always get somebody trying to price in the odds of a cut. But you would, let's say, need non-farm payrolls coming in really, really weak. Let's say at least 500k, right, below the forecast, which is crazy, and it's not going to happen. So if you're thinking of a potential cut at the July meeting, nada. It's not really it's not going to happen. You could see a move, a stronger chance of a cut being priced in, but not totally to kick out 91.5%. That would be very crazy if that were to shift from no change to a cut. September, though, is where you could see, if data was weaker than expected, a stronger pricing in of a cut and less of a chance of no change. But if data was to be stronger than expected, then you could see a stronger pricing in for no change and a weaker pricing in for a cut, but still a cut that could still be there, that still lingers. All right, so as we can see here, so this is what I took this morning. So 3 rate cuts expected, one in September, December, and January. 2 rate cuts expected, September and January. Let's go on to the next point. So we'll look at the last market reaction we had. Now, this is something we need to be careful of. Before the data, or just before the data came out, we'd seen a little bit of a whip towards the upside on the S&P 500. And then when the data came out, which was stronger than expected, then that you just saw there. So as it was strong, data was stronger than expected overall by a good old margin. And then the S&P had seen a decline. Dollar has seen an appreciation. You can see the CAD JPY from the last from the employment data that they had. Bear in mind, of course, if the US dollar sees an appreciation, other dollar-denominated currencies will also see an appreciation. Okay, of course, if you're looking at dollar CAD, it would be a different story. You'd see the dollar seeing strength against the Canadian dollar, or if stronger than expected non-farm payrolls. But other dollar-denominated currencies will usually see strength if the dollar or the head honcho sees strength as well. So that's something to bear in mind as a risk then for the non-farm payrolls data being paired with the Canadian employment change data. And that was what we had here for the Canadian data. Okay, it did come in stronger than expected, but not by a lot, enough to warrant something like this to happen. If I'm looking at the CAD JPY here in the top right, so that's something to be aware of. And unless you have really strong data from Canada and weak data from the US, then you get the inverse reaction where you see the dollar CAD then seeing weakness, and then you could see a bigger move from the dollar CAD, and then of course the Canadian dollar strengthening across the market by itself. But then you could see, as I said, that's something to just be aware of then as a potential risk that we could get with two of these data points coming out together. All right, so if I just skip ahead and we'll see how let me just bring it up again. Where are we? Yeah, so CAD JPY continued to move towards the upside, and let's get into the deviations. And the market kind of held its move of where it was. So again, let me just clarify that. Be careful of the initial whip that could happen just before the data comes out then. Of course, the markets are sensitive, or really sensitive to the data, but that's something that could come into play if just before the data comes out. So we've got about 7 minutes. Let's get out of this here. And let's go, whoops. Let's go here. Right, here we go. So the Canadian employment change data then, bear with me 1 second. Okay, so the previous report then, or what we had seen for the main data for June 7th for Canada, health and social care added about 48k jobs, finance and insurance, retail estate and rental, or anything to do with housing, added 29k jobs, business services about 19k, accommodation, food services about 13, construction saw a loss of about 30k, and utilities of about 5.4k. Then if we look to where the economy is at the moment, of course, we had the surprise rate cut from the Bank of Canada, the last rate decision, to 4.75% when they were expected to not change rates. Inflation rate ticked up to 2.9% compared to 2.7%. Average early earnings ticked up as well to 5.2 compared to 4.8. Quarter-on-quarter GDP for Q1 at 1.7% compared to Q4 1%. GDP month-on-month at 0.3% compared to 0%. Employment change at 26.5k or 26.7k compared to 90.4k. The unemployment rate ticked up to 6.2%, and manufacturing PMI was unchanged at 49.3. Now, forecast then, so Scotiabank seeing 25k, BMO, all of them are looking at 25k other than Toronto Dominion or TD at 20k. Citi said the economist warned that wage growth could be uncomfortably strong, but largely due to base effect, and they said that to watch out for the unemployment rate, which the consensus expects higher at 6.4% compared to the prior of 6.2%. And then this is the estimate then, or the expectation for the Bank of Canada and what they're expected to do in July. If data is weaker than expected, that could lead to a stronger chance for a rate cut. And because we're kind of close to that 50-50 area, if the data is weaker than expected, then the chance that the cut then takes over the hike, takes over the no change, is quite high. There's a high possibility of that occurring. If data is stronger than expected, they need to see the chance of a cut being pushed further out. And and then maybe even you see a lot of it's 50-50 here, besides maybe the December meeting. So very sensitive in regards to the data overall. Particularly the CPI data. So if the Canadian data is weaker or stronger, then you could see either a shift into one direction for a cut, or a decision to keep rates on hold overall. And then quickly we'll go through the Bank of Canada views. Macklem said it's reasonable to expect further cuts on June 24th, is what he said. I said the Bank of Canada is looking for further moderation on wage gains. In assessing implications for wage growth for labour cost and inflation, it is important to separate out wage gains that reflect productivity improvements. So let's get out of this. I want to go through the ranges and deviations, and I'll just get my chart set up on here. But yeah, the ranges and deviations are what we had last time round for the data. Okay. All right, there we go. I'll close it for now. All right, so ranges and deviations, here we go. This is the last market reaction. The biggest market reaction from the currencies was the dollar yen, and it's consistently been the dollar yen for non-farm payrolls. Hopefully you can see that here. There we go. So the initial market reaction, okay, that's what this represents here, this candle, this first figure, going to the wick of the candle on a 1 minute chart. We'd seen about 98.5 pips towards the upside off the back of the data. Okay, and before that, it was about 100 pips on the last report off the back of weaker than expected data. But this was stronger than expected with a 92k deviation. Huge. Then after about 30 minutes of trading in the black brackets going to the end of the candle, it was up by 117 pips. And after about 30 minutes of trading, all in the same direction, up by 133 pips. With the NQ, so NQ also had seen a strong move towards the downside. Not as strong as what it was, a strong market, not as strong as what it was to the prior release, but still was quite strong. So about 393 ticks down. After about 10 minutes of trading, it was down by 402, and then after about 30 minutes, 404. So we need to just be careful of mixed data then. If non-farm payrolls is stronger than expected, but you get the rest of the report that is weaker, then you could see more of a mixed market reaction. So ideally, if you want a strong dollar reaction, you want the unemployment rate to go down, the non-farm payrolls figure to go higher, so a big deviation from that. And then, of course, you want the private payrolls to see a strong upside move, a strong deviation towards the upside, and you want the average earnings to see a move towards the upside as well and be stronger than expected. And then vice versa for if you want to see stock indexes to go up, then you want to see the opposite. You want to see unemployment go higher, non-farms come in much weaker, private payrolls come in much weaker, and the unemployment rate to come in, unemployment rate to go higher. I think I already said that. And average earnings, of course, is quite key to go lower. Okay, so we've got about 15 seconds. Hopefully you guys are all ready. Hopefully you guys found that useful. Don't forget to give the video a like, share, and subscribe to the channel. All right, let's see what we get. Okay. 206k. Let's see what we got at the market. Let's see what JPY did. Okay, so strength from the Canadian dollar. Canadian employment change. Okay, this was weaker than expected for Canada. Indexes seeing a move towards the upside there. So data. All right, so the deviation that we were looking for then for the data for non-farm was at least 47k on the high end and 50k on the low end. Didn't get that, so got about 16k deviation, but there was a whip from the market. So didn't really get strong movement then, or strong deviation, and hence you get that whip from the market off the back of the data. Let's see what else we got. So dollar yen, yeah, that was from the data, that whip. Beforehand you didn't get that whip. Okay, I'll have a little look at what sentiment is doing in a little bit. Okay, gold. Oh. Gold, a whip there too. Let's get that back. Let's see. Dollar yen, yeah. Let's do a quick measurement then. Let's see what this little move was first. 26, and then 54. What did we get last time round? Oh, non-farm. Okay, so weaker reaction overall from the initial candle to the wick then. About 54 ticks. Last time we had about much weaker reaction. So last time we had 97 ticks towards the downside on the S&P. This time we get 54 ticks towards the upside after the going to the wick of the candle towards the upside off of the back of that data. So okay, yeah, not really a great report to trade then, particularly with how it just whipped around. Canada, let's bring up Canada, see if we've got anything better. Probably unlikely. Okay, maybe. What do we got? Okay, yeah, nothing really too interesting. GP CAD having a good bit of time, but the reaction, yeah. So you can see also then with the Canadian data, with the US data, came in stronger than expected. Didn't get the 50k or about 50k deviation that we were looking for on the high end, enough for then the dollar to go higher or lower. So you had a crazy bit of reaction from the dollar, and then the weakness that came from the dollar that also led to the weakness for the Canadian dollar too. Yeah, so let's have a look at let's do AUD JPY. So go across. Yeah, there we go. There we are. Yeah, so a bit of a mix there, back there. But it is doing better against the Aussie dollar is doing better against the yen compared to the Canadian dollar here. From the, just make sure I got that there. Yeah, from the initial market reaction, albeit it was still choppy, but now seeing a bit more of a better move towards the upside here for the Aussie dollar against the yen. If we did, let's do AUD, let's do GBP, AUD, see what we've got there. Yeah, okay. Yeah. So it is just a bit of a mixed bag then. Not really that great, to be honest then. So probably just, I guess, something just to keep away from instead. All right, so that concludes MACROACE. And also, if you're looking at our FJ Elite stuff as well, let me just go over the ranges and deviations and bring that up for you. Let's just get that out of the way so you can see clearly. Okay, so MACROACE with the ranges and deviations sheet, what it shows you is how strong were the market reactions to economic releases. So we look at it on the 1 minute chart, going across the first minute reaction, 10 minutes after the release, and then 30 minutes after the release has occurred is what we look at here for the. Of course, if you're day trading, that's what you want to know. What is the short-term market reaction? So we break it down for you, so you're able to see that in a nice and clear way. And of course, updates have been made to make it a bit more snazzier and look a bit better compared to what it was, what it looked like before. But yeah, so let me just go over the market reactions and how it works. So here we have the initial move going to the wick of the candle, okay, on a 1 minute chart. Then here we have the market reaction 10 minutes after the release has occurred, going to the end of the candle. So the first figure is capturing the entire move. This one's, and the black brackets, is going to the end of the candle. Then the blue bracket, 30 minutes after the release has occurred, going to the end of the candle again. And then you get an idea then of how long then does the volatility last for. Was the data actually that strong? Because if it was strong, then you may get a market reaction that lasts longer than the initial market reaction, where you see here initially about 97 ticks towards the downside, but over time it started to weaken a bit further, not by a whole lot, let's say, after about 30 minutes or so, but you can see that direction that is then created. Okay, so of course, one thing to note as well, where you do get data, if there is a bit of a whip on the market reactions, and we'll put that in today. So I'll drop down what the initial move was of that whip. So last time on 8th of March, it was about 57 ticks down, and then it was 43 ticks towards the upside on the 1 minute candle. And then if you see here where it says 51 and it has a word saying up or down, that means that there is a market reversal of that initial trend that was created off the 1 minute chart. Does that make sense? Hopefully that makes sense for you guys. I've tried to make it simple as possible, but also enough detail so then you can interpret it in your own way as best you can. Billy Goat said yes. IKT Robert. Oh, sorry, I just saw your message now. I'm looking at gold protection in the news. Well, I mean, in future, if the data is stronger than expected, then you get this. Then usually if the data is much stronger than expected, then you get a weakness from gold. And then if the data is weaker than expected, then you get strength. But this data was a bit more mixed, so it was a bit harder to kind of see which way the market was going to go. Hence, you get this mixed market reaction that we see here. But for those of you who want access to the ranges and deviations, of course, not only do we cover non-farm payrolls, the Canadian employment change, but we also cover the rates, and we have the inflation data. The new ones we put in, what we had is New Zealand CPI, Australia CPI quarterly, and the monthly figures, UK and the Swiss CPI, what we had this week as well. Again, also adding in the sentiment then of what to expect, of what markets are expecting now for rate cuts or rate bets in total. A load of different releases. Some releases we'll see that nothing's been added because the market reaction has been not as strong as it used to be, and it's been a bit lackluster. But of course, we'll let you know which releases we're going to cover in our MACROACE mailing list. Okay, so the mailing list, if I just get you the link here, if you want to get your hands on the ranges and deviations, let's grab that up here. Right, that's over there. That's the link there for you to sign up to the MACROACE mailing list. Again, as said, it gives you the link to the ranges and deviations, and I send out one email a week on a Monday in the morning, just before the US session or around the start of the US session, at around 8 a.m. Eastern time or 1 p.m. UK. And in that email, that you guys, if you were to sign up to it. It is, let me just get the latest one here for you as an example, because it's quite detailed. A lot more detail than what it used to have. I try and keep it as short and snappy as I can, so you get like a refresh of, and you get like a little bit of an idea of what to expect for the week ahead. So this is an example of an email that you guys would get on a Monday morning. A list of just a bit of an intro, which releases we'll be covering, and also any other releases that'll be added to the ranges and deviations if we're not doing as a live stream. A short rundown of the different sessions, Asia, Europe, and the US. Anything that was important last week and anything important for the week ahead. A bit of a summary of the markets as well and how they had reacted. That's something that's new, the market summary, that hadn't been there before. It was in for one of the emails, but then streams there as well. Okay, for the week ahead. Okay, so more detail than what the previous emails used to be, but it's still short, and try to make it as snappy as possible, so it acts as like a refresher then for last week, and also what to expect for the week ahead. So that's MACROACE then. I've given you the link now to be able to have a look at that. Well, to sign up, and then Monday you'll get an email to then be able to see the ranges and deviations, and that's completely free. There's no charge. All you gotta do, sign up, show your support for MACROACE, and just spread the word is all I ask. Spread the good word of MACROACE, and then hopefully we can take over the world and tell people, or help people. Tell people. That'll sound like an imposter. Sound evil. Yeah, just help people understand how to trade economic releases better and what to expect, is what I should say, for economic releases, and a better understanding of those indicators. Yeah, takeover season. Well, you've already had Starmer that's taken over the Conservatives. Trump, that is likely, or is very likely, to take over the Democrats, unless the Democrats find a good substitute for Biden. But that's if Biden agrees to step down and let the party decide who they want instead. If that be Kamala Harris or Gavin Newsom, or if they find some hotshot, I don't know, from somewhere, one of the Democrat governors. So, I mean, we'll see. But at the moment, it looks like if Biden doesn't want to go, he doesn't want to take his nap, then Trump might come in and then take over power. And then you have red in the UK and red in the US, but for different reasons. Red being the more left in the UK, and red being the more right, being a little bit more to the right with the Republicans. Okay, so that's MACROACE there. Financial Juice. Now, if you guys have heard of Financial Juice, then you know that it's a live voice and text service. This Squawk service basically keeps you up to date with what's going on in real time, giving you live updates via voice and text about what's going on within the market. So you can see here, US short-term interest rate futures reversing earlier losses, now mostly up before the June jobs report. Slightly stronger chance of a September and a December rate cut after the jobs report. So again, we keep you up to date with what is the sentiment, what's causing markets to move. Has there been a particular headline that has caused the markets to move? Via voice and text, all live and in real time. So if I bring up the market moving stuff here, if it loads, there we go. And let's find a headline for you guys, just to show you why it's important. So here, Diplomat, Candor, why fundamental news is important, and then what then drives the markets. So here, Candor talking about taking appropriate steps on Forex as needed. It needs seen the yen see some strength. Then other areas, for kind of to skip down a little bit. Ueda comments about the reduction of JGB purchases as well, causing the yen to see some strength there. A lot from the BOJ. Let's go to Lagarde. You have comments from her there as well. Again, there are loads of examples. Then, if you work your way through the market moving a tab that I selected to be able to see why it's important to have a live voice and text feed open in the background or open in front of you, or however you want to do it. There we go. Now the odds of a rate cut at about 6.5. No change. See a stronger expectation of that. A cut chance of about 74.5%. November, no change. December, about 77.9. Yes, not really a huge change, but a little bit more expecting of a cut. So with just finally then with financial juice, you're on the left hand side, you have the economic calendar of the upcoming data for not only the week ahead but also the day ahead as well. And I said you have your live voice feed, which is right here. Okay, hopefully you can see the little slidey button for the voice. And then if you do decide to, if you do want to go pro, then we do have an offer at the moment to go pro to get Financial Juice a year subscription of Financial Juice. So instead of paying about $1,100 for Financial Juice for a year, you get a juicy 92% discount for FJ. Okay, so all you got to do then with the promo code is pay $99 for a year's worth of Financial Juice for the service that we provide. Okay, a juicy 92% discount, a T-bone steak juicy discount is what, or a lion steak, a lion mushroom steak. That's it. I remembered what it was now. A lion steak discount for if you're not into eating meat, then for our vegan brothers and sisters out there, or vegetarian brothers and sisters out there, that you can have that. But yeah, as said, you can get a juicy 92 promo. So that I'll double check, Alex, on that. But I don't take my word on it. I will say yes, but I don't want to say no, because then it could be the case. I'll check with Amar and see what he says. But for the year, I think it would just be for the year is my presumption. Is what would oh, you did yours last year. Yeah, okay. Do this. If you pop an email to support@financialjuice.com, and then I didn't have in my. Yes, if you pop a question to support@financialjuice.com about that, and then you can get some further clarification. And anyone else who's in the chat who's taken the juicy 92 juicy 92% discount, who's taken up that offer, have a little double check. But I think it is just for 1 year. So but renewal wise, I'm not sure how that's going to work. But send a question to support@financialjuice, and then hopefully you can get an update as to how they'll work out. I am not the finance man. Corrected. I am not the man who deals with people's payments. So, yeah. All right. So Financial Juice, you get that there. Now, if you're not a subscriber to Financial Juice and you've never come across it before, first make an account. Okay. Once you've made an account, that will take you to the light version. The light version has a delay to the service. There are adverts that do pop up. And I said there's a delay across the site on the light version of Financial Juice. Also, of course, we have some new stuff on the site too, which is the Moo and Mock data. Yes, the market on open and market on close, which is really snazzy. So keep your eye on there. on the top part for the market on open for the order imbalance stuff. Billy Goat says you can write it off on taxes depending upon the country laws. As business write-off too is just a little gem. Yeah, good. Alberto Mo says thank you for your dedicated service, FJ. Thank you guys for joining us. Yeah, don't forget to like and share and subscribe to the channel. Get the word out there. Of course, if you found it useful, I don't want to force you guys to do anything. Do it now. Anyway, so that's Financial Juice. So yeah, if you want to go to Pro straight away, make sure you have an account on Financial Juice Elite. Once you've set that up and you've verified your account from your email, then there'll be a button here on the top left hand side where you should be able to see where I'm clicking, which will say Go Pro. And then once you've clicked on Go Pro, then put in the Juicy92 promo code, pay for your subscription, then go back to Financial Juice, log out, and then log back in, and then you'll get the pro version of Financial Juice and this sleek, beautiful feed that we have here of the feed. Okay. All right, so that's Financial Juice, and then finally with TICKSTRIKE, let me get that back up and running. Where'd it go? I'll pin the Financial Juice Pro thing for you there at the top. So TICKSTRIKE, again, if you've never come across it before, it represents how strong the buying or selling momentum is for that for a range of assets that goes from FX, stocks, you have futures, looking at everything, crypto, your internals like your ADD or VIX, also the ETFs and ETNs as well. That's what TICKSTRIKE also covers as well. But the way that what TICKSTRIKE does is it shows you the strength in the buying and selling momentum of those assets via voice and visual, via sound and audio, via audio and visual. I need to get my voice sorted, my audio sorted on my side. Anyway, so TICKSTRIKE, here we go. Here's an example. Let me just bring up the S&P. Oh, there we go. So this is the ticker box. And as I said, this represents the buying or selling momentum strength for that asset. So here with the S&P, so the numbers go from the level of, it has a sensitivity gauge. One is is very sensitive. So when there's a little bit of buying or selling that occurs, then TICKSTRIKE will give you a visual and audio alert. And as you increase that and you go higher, okay, all the way to 15, 15 is the least sensitive to market reactions. So only when there's a big buying or selling amount that's going on, or momentum that is occurring, only then will TICKSTRIKE give you a visual or an audio alert. Or so I should say, when there is a strong amount of buying or selling that is occurring for that time, for that asset that you're looking at, that TICKSTRIKE will give you a visual and audio alert for it. So of course you can chop and change that to whatever you want to be. Again, if you're day trading and you're looking to capitalize on potential opportunities within the markets, manage your risk for a current trade that you might have, then that's a couple of the ways that people can or have used it. Of course, find your own way in how you want to use it. Another thing to add as well is we have, if you like to scalp the markets for every little bit here and there, and you're a hardcore scalper, then this lightning bolt, if I click that there, that makes TICKSTRIKE uber sensitive then to the market reaction on the asset that you're looking at. So if I said 1 is very sensitive, if I click on the lightning bolt, that goes 15 levels below 1. So then TICKSTRIKE is an uber sensitive and very sensitive. So if I move my mouse away, you'll see the strength in the buying and selling momentum compared to the other tickers. There. Right, so every little bit of buying and selling that is occurring, let's put the NQ on 1. So yeah, every little bit of buying and selling that is occurring within the S&P at that point, then TICKSTRIKE will give you a visual and audio alert to what's going on. Okay. All right, and let me just put that and take that off. Okay, so put that back to my kind of preferred level, where it's around 8 kind of works for me better. Of course, you guys find your own levels, whatever works for you. But let me give you the link to TICKSTRIKE then, which is here. That's the link to TICKSTRIKE there. Now, if you don't want to sign up to TICKSTRIKE and you want to have a play around, then there is the free version on financial juice. Bear in mind that is restricted to only 4 assets: S&P, Euro, Dollar, Oil, and Bitcoin. But you can still have a play with it. Regardless, so if you're a pro member, you don't get TICKSTRIKE included in the package. So TICKSTRIKE is a separate product from Financial Juice Pro. But you can still have a little play with it. And you can, kind of figure out if it works for you or not, and then you can have a play with, and then you can see, and once you get used to it and you feel more comfortable, then you can sign up to the pro version of TICKSTRIKE, and then have a little play with it, and then of course, hopefully you do really well with it. Okay, right, of course, yes. So if we're looking at TICKSTRIKE, it's great to see how, if a certain asset class or a certain group of assets are moving in the same direction. If let's say if the dollar is moving in one direction overall, or let's say if stock indices for the US are seeing a bit of a mixed choppy reaction, or if they're going in one direction, then you can kind of gauge what the momentum or the strength is like, whether it be buying or selling. Or if there's something that's specific, maybe there's specific news that's related to the S&P seeing a downside, whilst the other indexes are seeing a move towards the upside, and vice versa, and so on. So there are many ways you can use TICKSTRIKE, and not just a couple of ways that I noted initially. It all depends on how you use it, whether it is for market correlation or looking for, say, if there is a negative correlation then that is occurring between two assets that should see a positive correlation in tandem with each other. Alrighty, ladies and gents, that concludes MACROACE, and of course anyone joining from FJ Elite from the site, from the feed that we put out for FJ Elite. Don't forget to give the video a like, share, and subscribe to the channel. Next week we have CPI and PPI as well. So we're going to be quite we're not going to be, it's going to be a quiet week for the majority of the week for all of the sessions really. But as I said, CPI on July 11th, and then we get PPI on the Friday, the day after. So those would be the two main events. Alrighty. Have a great... Oh, lordy lord. Okay, have a great Friday. Enjoy your weekend, and I'll see you guys next time.